Welcome back. We are at the JPMorgan India conference, and with me is Bansi Desai, who is the India Healthcare and Pharma Analyst at JPMorgan. Bansi, thank you very much for joining us on ET Now. Healthcare, especially generic companies, are in focus because of the Trump tariffs. Of course, there hasn't been much. They've been under the exempted thing pending an investigation. How do you see the generics, playing out from here?
Sure. Thanks for having me. So if you look at India's generic business, this largely accounts for 1/3 of Indian companies' revenues, and we've come a long way here. We account for almost 45 to 50% of U.S. generic drugs consumed in the U.S. market. So we've really, scaled our business quite well here. We play an important role in the U.S. Generics does reduce healthcare cost burden, for the U.S. economy. So it plays a very pivotal role. In terms of tariffs, at present, the pharma sector is exempted from tariffs. We will await Section 232 investigation to probably get more clarity in terms of whether and if tariff is proposed and at what magnitude. Until then, we believe, this definitely presents an overhang. But fundamentally speaking, this is a space which is, offering, the U.S. government to lower cost. It is saving cost, for them. Plus, we are a very big part of their supply chain. So it's very critical from that standpoint. But, we are awaiting more clarity from the government.
The Trump government also wants pharmaceutical sector to set up shop in the U.S. Do you see that in some of the Indian generics moving to the U.S., setting up plants and manufacturing lines there for the U.S. market?
So if you see, a lot of leading companies already have manufacturing presence in the U.S. So for some of those, it will be easier for them to manage the supply chain if at all, tariffs are imposed. But largely speaking, from a cost economic perspective, it usually takes 3 to 4 years for Indian companies to go and put up plants, have your approvals in place. At the same time, if you look at the cost of manufacturing drugs between US and India, there is a huge difference. It's almost 50-60% higher than manufacturing in India. So keeping cost economics in mind, keeping the lengthy approval process in mind, we really need to see whether those decisions will be made or not.
Among the Indian generics, which companies are much more safe with respect to this entire headwind which you're seeing, or the overhang which is there?
So as I mentioned, a lot of large...
It's relative in nature, but yes.
Yeah. So if you see companies like Lupin, Cipla, Sun, they do have manufacturing footprint. I would say generally from a tariff implication standpoint, we believe larger companies would be better, will be in a better position to withstand any implications of tariff compared to the smaller one, purely because of their scale, purely because of their experience. They'll be able to, tide this through. I'm sure whatever is the tariff, these companies will have a combination of strategic and operational responses.
Have you also looked at the scenario where if the India-US tariff trade comes into play, agreement comes into play, and there is a base tariff which comes into play? How does the Indian generics, stand to gain or lose in that scenario?
Well, it remains to be seen. We don't have a precedent of any tariff level, but our sense is that a modest tariff level, say for instance, if it's in the range of 10-20%, maybe industry will be able to absorb some, pass on some of it, and you would not see probably much impact on the P&Ls. But if you're talking about tariff levels which are like 20-30% and higher, then one really need to see whether you'll be able to pass that on completely. If yes, then you see minimal impact. But then we ourselves account for 45-50% of the US generic volumes. Also at the same time, one has to think about the second order impact here, right? So say for instance, if tariff is levied uniformly across all the regions, then again, comparatively speaking, India does stand out. India does have an edge because of its cost leadership and because of its scale. So second order impact, in our view, could actually turn out to be even favorable. But we need to see, how those trends evolve.
You spoke about the supply chain. The CDMO is one sector that you track very closely. How do you see that industry? Because in the last couple of quarters, we've been talking about the coming back of the CDMO, but every company talks about the next quarter is going to be better, but it doesn't happen that way. What's ailing this sector? And what are the triggers that you see for this sector?
So firstly, from a CDMO perspective, let me clarify that from a tariff implication standpoint, this is one sector which we believe will be insulated. The reason being the burden of tariff actually lies on the clients. That's number one. Second, also the supplies of CDMA to the large innovators form very small portion of their P&L. So it's also easier for them to absorb those kind of costs. But talking about the sector and its longer term potential, we believe we are very, very small in overall scheme of things. So overall global CRDMO market as we speak is over $200 billion in size. And India accounts for only 4% market share today. We are one of the fastest growing country globally speaking. And we are also fast emerging as a preferred partner. And this is because of multiple reasons. A, we see structural macro tailwinds. So rising outsourcing penetration, diversification strategies by large innovators, be it EU +1, China +1, US-China tensions, all of this is driving incremental business to Indian companies. The second is India also offers cost advantages. It also offers large pool of scientific capabilities. The regulatory and compliance track record is also solid. In fact, in terms of labor cost, we compare favorably to China. So there are these, inherent cost advantages as well. We are known for our cost-efficient manufacturing. And last but not the least, when we look at the companies, all of these companies are expanding their capacities. They are also enhancing their capabilities. For instance, traditionally, we Indian companies have been known for our strength in small molecule segments, which forms 50% of the overall CDMO market. But gradually, we are moving into complex domain, such as advanced drug conjugates, which is ADCs, oligonucleotide, peptide. Our capabilities are nascent here, but surely, we are advancing on this space, which is all driving higher TAM, which is target addressable market for Indian companies.